Since the year 2000, something had changed. No longer were there cycles. No longer was there a separation between one country and another. All markets moved in lockstep, in complete sync with each other. This was a first in history. And why? Because central banks colluded together with the financial establishments to ensure an appropriate action plan will always be coordinated. You came here for the truth, so let me unveil that for you. Today we are going to look at this among other things. Let's begin. This first chart is a little outdated, but it shows you what I wanted to get across. And that is, since the year 2000, all of the markets, since that pinnacle moment, have been moving together. Yes, there are variances, but in general, they move together. When times are good, everything moves up. When times are bad, everything moves down, and it repeats over it and over again. But historically, that doesn't make sense. There would be times when emerging markets were doing very well, and the US, for example, would be down, and then that trend would reverse. You have seen the crises before in history. Some markets were up during these major crises that were experienced around the world. But now, there's the everything bubble, where everything just moves up and up and up and up into the sky. Nobody's asking why, but the truth is very clear, and that is central banks working together. They are this orchestra playing for you and I, deciding what the stock market will be at on that given day. They are the ones who make this happen. But people want to ignore that. This is a central banker's world. Beginning with this one really gets into how bad things really are. Variability in GDP growth across countries is the lowest in 50 years. You could see this level here is quite absurd because you haven't had it in 5 decades, and here we are today. Why? Because they're all doing the exact same thing. They're all printing money, they've all lowered interest rates, they've all had these massive mountain of toxic debt on their backs. Their nations are in a very big amount of debt right now. The individuals are in a massive amount of debt. They are all expanding their debt to income ratio at higher and higher levels. You're seeing their assets rise. They're pulling out equity, home equity loans. You can see all this. This is global. So if everyone's doing the same thing, of course you're going to see the same numbers popping up all around the world. And that's not a good thing. You want to have those variances. Where are you going to hide? That's the point. History of global cross-asset implied volatilities. When you can't even see the volatility anymore, it goes down to levels never known to so many people, it should be frightening because oftentimes things change in an instant, and the volume as well is down at levels that is technically very rare. The divergence between consumer delinquencies and unemployment rate is at record levels. Yet again, record levels, record highs. How many times do I say record low, record high, record level? It happens all the time. Okay, so the darker line is the consumer 90-day delinquencies. You'll see that here. I mean, it fluctuates obviously, but you'll see that over time this is increasing. And then you see the US unemployment lie rate that is just continuously declining. What a stupid number this is that people believe it, and that's really sad to me. I mean, we should be reading storybooks instead of this news here. On the news, whatever it might be, you know, your mainstream media, they should start reading nursery rhymes to people just like their children because they believe it. And I'm not trying to be insulting, I'm being serious. Looking at this little bit further in detail, consumer and mortgage loan 90-day delinquencies and NPLs, and on the right hand side, consumer and mortgage 90-day delinquency rates by loan subsector, essentially showing you more of the same, that there are more delinquencies right now. People can't pay back their debts. They are in an extreme situation, but we're not allowed to talk about it because then you're being insensitive. Median debt to assets by income cohort, median debt to assets by age cohort. Okay, it doesn't matter what we're looking at. There's more debt. Okay, that's all I wanted to say. There's a lot of people who will make things complex. I like to make things as simple as possible. If you've read one of my books, you'll know that's the case. I actually went through and scrapped at least 25% of the book because I thought to myself, we have to make it more simple, more simple. Simplify, simplify. I got rid of entire paragraphs and I used just one sentence. That's how I would do it. If I can make it even simpler, then do it. That was my whole philosophy. I applied the same thing to my videos. S&P 500 price to sales ratio, haven't hit this since back in the dot-com boom and bust. That's right. So this is just one more indicator popping up, but who cares? Who cares? Just another indicator, just another number. Don't worry about it. No matter how high these get, no matter how bad the things get, have no fear because the central bankers, Janet Yellen, the wonderful, will be there to rescue you. Well, I perhaps have a difference of opinion, but that's just me. If you found this video informative, please give me a thumbs up. Last but not least, if you found the video informative, I know you will find my books, The Money GPS and my newer release, Global Economic Collapse, even more informative. You can actually flip through these books. If you go over to Amazon, they have a look inside feature, which will allow you to flip through the pages of these books to see if you like them. Take care.